Welcome to the second half of 2023, the Q3 market review. Let's get right to it. There was plenty to worry about in the first half of this year. Inflation, rising interest rates, supply chain snags, and declining profits, to name a few. And as the worry increased, it led to a crisis of confidence that culminated with 3 bank failures. That period represented a low point in March, and interestingly, even as worry and doubt increased, so did the market. Stocks have been on a steadily positive climb in face of a debt ceiling standoff, a housing standoff between buyers and sellers, and looming recession concern. We call what the market is doing right now climbing a wall of worry. Behavioral finance is fascinating, and investors' feelings and actions don't always coincide. The American Association of Individual Investors survey recently shows investors are above average pessimistic about the market, while at the same time holding a historically higher amount of stocks in their portfolios. Money managers and economists watch these surveys and money flow to give them an idea of where the markets are headed, and right now, feelings are mixed. And besides the investor surveys and money flow charts, the fact of the matter is the markets have bad breath right now. And of course, that's breadth with a D. Some people call it a skinny market, but I think it's more fun to say it the other way. What's going on is this. The majority of stocks are actually down this year, while the averages are up. How can that be? Well, the major stock averages we watch and compare our portfolios to are not a simple average of all the stocks in that index. They're either a price-weighted index like the Dow Jones Industrial Average, where a stock with a higher price gets more weight in the average than a lower price stock. Or they're market cap weighted, where the larger sized companies receive a higher weighting in that index, such as the case with the S&P 500 and the NASDAQ. And this year so far, a handful of the stocks have been responsible for the majority of the positive market index returns. For example, Apple and Microsoft are each up over 30% this year, and together they make up 14% of the S&P 500, which is made up of 500 companies. The third largest stock in the S&P is Google, now called Alphabet, and it's up about 40%. NVIDIA is really on a tear, up over 100% this first 6 months of the year, and it's the 5th most weighted stock in the index. In the stock market, we sometimes call these mega cap stocks the generals of the market. A quote attributed to General MacArthur states that a general is as good or as bad as the troops under his command make him. The generals have been marching forward bravely this year, but the troops are not following. And this is where the divide between different company chief investment officers begins. What happens next with the troops, meaning the rest of the stocks in the indexes, matters. If they fail to join the charge, the battle for this bull market will be lost. I'm in the camp that believes the market will end the year on a positive note. If the Fed does stay on hold, it could solve a lot of the market's problems, and staying steady does seem plausible. The best opportunities right now, I believe, are in cyclical stocks that have been hit particularly hard this year. Financials, energy, industrials top that list, as they're poised to rally if the economy holds up better than expected. On the technology front, I've been working on a new client portal. If you haven't already received an email that your portal is ready, you will soon. Please try it on your desktop and let me know what you think. I'll also be rolling out an app for the client portal soon. You'll be able to see your household account balances all together, as well as each individual account. You'll see performance, estimated annual income, gain loss for taxes, information on each holding, and also my Twitter feed. In your vault, you'll see your fidelity statements automatically populate where you can easily find them, as well as your future tax documents and any special reports that I send to you. And you'll have a personal vault for your sensitive information. For my clients involved in retirement planning, you will also have a Money Guide Pro portal with your retirement plan always showing and updating, and you can enter your outside accounts to link up like you did with eMoney, including your 401k, bank accounts, the house, etc. I will close eMoney once everyone is settled into the new portal. In our Rhino Education series of videos this year so far, you'll see on my Twitter and YouTube feed, we've highlighted the areas of behavioral finance, cryptocurrency, retirement account rules, investing tax implications, history of the markets, and Social Security. Let us know what other topics interest you, and we'll be sure to include them in the future. Coming up soon, we already have a series on inheritance, successful withdrawal rates in retirement, how to budget in retirement, and the top mistakes I've seen investors make as a financial advisor for over more than 30 years. Thank you again for watching and being a part of our Rhino community. As always, talking to you is the best part of my everyday, and I look forward to sharing more content soon and seeing how the year plays out. See you there. Welcome to the Rhino Investor Educational Series. Like and subscribe to charge along with us.